Good afternoon, everyone, and thank you for joining us today. I'm Michael Episcope, co-CEO of Origin, and I'm here with my partner, friend, and fellow co-CEO, David Scherer. Let me get this disclaimer off the screen, and we can jump in. That's our standard legal disclaimer. It's actually been a long time since I've been genuinely fired up about this webinar. We've been playing a lot of defense over the last 3 years. There was always some good news on the horizon, but the bad news is generally what dominated and what people wanted it to talk about. And we were always looking for the silver lining, trying to balance the news. And I think we've done a pretty good job of navigating this fund through one of the worst storms in the history of multifamily. Today, though, this sentiment, it really feels like we are at a turning point in this market. And it starts with sentiment itself. It's palpable in the conversations we are having and in the data we're seeing in the marketplace as well. I was at a conference yesterday talking to RAs. These are wealth managers, advisors who allocate capital for a living. And the conversations, they were just different. The conversations about real estate, it's been different than it's been certainly in the last 6 months, 2 years, maybe even 3 or 4 years. The questions have shifted. There's genuine interest again in real estate, which I personally find quite nice, much easier to have those conversations when people are coming to you. And I'll go into the data here in a few minutes. And I'm also going to make a special announcement that you do not want to miss. And then I'm going to go over the portfolio performance as well. And so Dave is going to cover the recovering macro environment, look at that, and then he's going to dive into a few of our deals. And after that, we're going to open it up for Q&A. So let's get into it. So this kind of says it all. You can see the title of the slide, Investor Sentiment Has Turned, and it tells a story in what I'll call 3 chapters. And if we look at the low point in the market, that was kind of 2024, interest rates peaked. We were about a year and a half into the recession at that time, which you can kind of pinpoint till, maybe mid 2022, 2023. Only 8% of RAs plan to increase their private real estate allocations. And this is one of the biggest sources of capital in the market, the wealth managers, the individuals. So 92% said, we're not touching real estate. We're not going near real estate. We're not reallocating. We're going to sit on what we have. And the institutional sentiment around real estate was incredibly negative. 70% of institutions had a negative feeling about real estate at that time. Everything that could go wrong. You had rising interest rates, rising cap rates, rising expenses, insurance rates at the time. So it's kind of makes sense that there would be a negative sentiment. And I have to tell you, it's a pretty lonely place to be if you're raising capital and investing in this space. Recently, though, or I should say not recently, but by the end of 2025, which isn't too far in the rearview mirror, the number of wealth managers looking to invest in real estate jumped to 42%. So that's a 5-fold increase over a period of like 12 to 18 months. And now in 2026, the most recent evidence research that we can find is that 74% of investors are planning to buy more assets and 97% are maintaining or increasing their allocations overall. So you can see, the huge difference between where we were in 2024 and where we are today in 2026. Think about what that means. The conversation in this industry, it is completely inverted. And the question is always, why is sentiment turning? I think every investor really uses the general framework of thinking. And that's regardless of whether you're an individual or an institutional or a wealth manager. And here's the general calculus that I think of that people do in their brain. And so they go over and they look at it and they say, multifamily real estate, it's been a great asset for 40 years. It's still an essential asset. There's nothing fundamentally wrong with it. This isn't the cassette tape market. There's nothing structural here. This is just your garden variety recession caused by interest rate, cap rates, supply. Maybe it's not so garden variety. We've been in it for a while. So we've been here for 3 years, right? That's kind of point number 2, which is unprecedented. And prices now are looking very attractive. The market has reset. The last thing is sort of evaluating risk. Cap rates and interest rates are elevated. So I have to be, less worried about those than I did 5 years ago when they were at historic lows. In fact, maybe those provide some tailwinds in the future. And I'm sure many of you are thinking about this. And then the other thing is, okay, well, if I'm wrong by 6 months, maybe 12 months, because I do believe there's going to be a recovery here, I still make 6.5% in tax efficient yield while I wait. And I think that's the arc of every story as we're looking at these markets that have been distressed, that have been oversold, for quite a while. We as investors are willing to go in at a certain point if we think we're being overcompensated for risk. And ultimately, what everyone is getting to is there an asymmetric return to the upside in this asset class? And so that's the general framework for why capital has become interested again. And you don't need AI, you don't need Excel, you don't need a complex model to understand it. Those are some of the conversations, the data, and there's also more data that also corroborates this as well. So this slide that's sitting in front of you, I've already kind of gone over the top three, so I'm going to focus on the bottom three boxes here. I did some research a couple of weeks ago because I really wanted to understand if this, quote unquote, change was pervasive throughout the industry. And let me give you a few highlights from what I found. The lower left, the Seyfarth Shaw, they're a law firm, large law firm, and they conducted a study that found that 86% of commercial real estate executives view 2026 as a year of opportunity. 86%, right? That's a huge number. We're not always that optimistic. You can go back and look at these statistics earlier. I mean, they were well below 50% a couple of years ago. The lower middle box is a data point from Newmark Knight Frank. This just has to do with the fundamentals. Annual multifamily starts, they have fallen 55% from their peak. Units under construction are down 47%. Dramatic pullback in new supply. Dave's going to go over the macro a little bit more in depth. And then Hamilton Lane on the lower right conducted a study. 86% of private wealth professionals plan to increase their private market investments in 2026. We are seeing this at the ground level too. I was in Phoenix last week with Dave, the rest of the team. We're at the Origin Retreat. And we always have a retreat in places where we have properties, and we have a lot of properties in Phoenix. So while we're down there, we toured our properties with our team, and we also toured some new ones as well. One of the things I love doing is talking to the property managers because there's really no one with better on-the-ground information than them. And the conversations there have changed too. Traffic is up, leasing is accelerating, occupancy is ticking up faster than expected, and they're reducing concessions. The tone, it's completely different than it was even 6 months ago. So you take all of this information and it really makes the case that real estate is entering a new phase of the cycle. So I told you you're not going to want to miss this part. This is the investor incentive program. And we've put together the program, and here's how it works. On the left-hand side, basically, these are for new investors. If you're new investors and you subscribe with a trade date between today and August 1st of this year, you will receive a 1% bonus on your subscription amount, right, in additional shares. So for example, if you invest $500,000, you will receive an additional $5,000 in shares on top of that. And no extra cost to you, no extra cost to the fund. This is borne by us, the manager. We actually pay this out of our own pocket. There's also a retroactive component, so don't be afraid if you invested on May 1st or April 1st. For those of you who invested on those dates, we are retroactively giving you bonus shares. Most of you should have already gotten those, especially if you were May 1st. But the reality is we weren't thinking about this program back in April, early April, or even March when people were coming in for that April 1st trade date. But we did decide to retroactively give you those bonus shares for those came in at April 1st. We're not going back further than that. So we've already done as far back as we were. As I said, it was only about mid-April that David and I started talking about this and thinking about the program. So we had no idea, it wasn't even a whisper in the market or at the firm in February and January and things like that. But there's no action needed on your part. This is already done. And if you invest new, there's no action needed either. We'll do that automatically. And the reason we're doing this is because we see a generational buying opportunity in front of us, and we want the capital to act on it. We know many of you have been sitting on the sidelines waiting for an opportunities, and this is it. Portfolio snapshot. So I'm going to go briefly over the portfolio, take you through kind of a past, present, where we're going, portfolio makeup. But this is a snapshot that you see in front of you. As of March 31st, the IncomePlus Fund has a net asset value of $608 million. The NAV per unit is $11.14. We strike that every month. And our current net annualized distribution yield is 6.73%. So when I was doing this webinar and I got that, I couldn't believe that it's that high. That is by far the highest it has ever been. And you have to keep in mind that the distribution yield is incredibly tax efficient due to the depreciation shield. So you're earning the taxable equivalent of more than 10, 11, 12%, depending on what state you're in that component alone. And again, if you don't need income today, you can just reinvest that right into the fund. And the good news about a tax efficient distribution that you're reinvesting is that you're not going to get phantom income, or at least not a lot of it. Our leverage ratio, it's pretty conservative at about 56%, sitting there right now. And let me give you a quick historical snapshot of the fund, and then I'll talk about the makeup and where we are today. The donut on the left, it shows the makeup of the fund's composition in March of 2025, so a little bit more than a year ago. 64% of the fund was invested in preferred equity, which is really a debt component. 22% was in development, and only 14% was in core stabilized asset. And that was by design. Anybody who's been following us for a long time knows that we intentionally overweighted the portfolio towards debt because that, to us, was the best place to invest money during the last few years. But today we've rearranged it significantly. And that's the middle donut that you see in front of you. Our debt piece has been reduced from 64% to 43%. Our stabilized asset sleeve is up from 14% to 42%. And some of that is just our ground up development deals. As they move through development, they go into that core sleeve. And some of our preferred equity investments have actually gone now into the more core bucket. 11% of the fund's capital is in ground up development. I want to remind you, our target is 20%. We always want to keep that full. That is our high margin sleeve. And that's one of the ways that we can generate that 9 to 11% consistent return over long periods of time and in a tax efficient manner. We're in a great position today and quickly moving towards that target portfolio that you see on the right-hand side. Ultimately, what we're doing here is we are reshaping the fund for a recovery to maximize upside. We want that debt sleeve to be south of 35%, probably closer to 30, and you might even see it get to 25%. If we continue seeing good things on the horizon. We want our ground up development, like I said, to be maxed out at 20%, and the core bucket to be around 50% to be set up for recovery. Because ultimately, in recovery, it's your common equity that is going to generate the most amount of upside and the development in there as well. So I'm going to move on to our track record here. I'll show you, kind of point out how we've performed relative to our peers over the last 1, 3, and 5 years. The fund over the last year has generated a return of 7.3%. Over 3 years, it's 5.6%. And over 5 years, the annualized return is 9.4%. So if you look at our competitors in this space, we have dominated in every 1, 3, and 5 year period. We were either number 1 or number 2 in terms of performance. It's not really even close over the 5 year period. The question everybody asks always, and this is the right one, can you sustain it? Those returns, they're not by accident. That is the result of a fund that I believe has a structural advantage, right? It has debt, it has core, it has ground up development. It's also a disciplined investment process. It allows David, myself, others on the investment team to tilt the portfolio in different directions and really monitor how the portfolio, what we need to do to enhance returns, to increase liquidity, to focus on downside. But having 3 tools in your toolbox is a huge advantage for a manager operating a fund like this. And it's one of the reasons why we've been able to outperform. It's also because it's focused exclusively on multifamily. And it's a team that has been doing this for nearly 20 years. So we're proud of the results. that we've been able to achieve. And I have no doubt that we're going to continue to outperform because the right pieces are in place to do so. What you see in front of you, this is our returns versus multifamily public REITs. So a lot of people, they invest in public REITs. So why not just buy a public REIT instead of investing in Origin, right? Or in the IncomePlus Fund? Well, I mean, the first answer is returns, and it is a good question. But what you see in front of you, these are the 5 largest multifamily public REITs: Avalon Bay, Essex, Equity Residential, Camden, Mid-America. We follow these. I keep these on my phone. I look at them daily to see what's happening in the trend, and they're great, kind of leading indicators to understand what's happening, like from a sentiment perspective too. Over the trailing 1 year, every single one of them is negative. That's versus our 7.3%. Avalon Bay is down 10.5%. Camden is down 10%. Mid-America down nearly 20%. And over 5 years, the best of the group, Avalon Bay generated a 2.5% annualized return, right? So we've significantly outperformed them. And I'm not going to tell you, I actually love public REITs quite a bit. We are only multifamily. Public REITs have a lot of other opportunities. You can go into data centers, you can go into timber, farmland, you can go into a lot of different sectors that we just don't have, industrial, things like that. But they do serve different purposes. They give you liquidity, they trade daily. I would argue, though, that liquidity, it comes at a cost. You get mark to market every single day. You feel every rate hike, every headline, every macro tremor. And there's oftentimes a complete disconnect between the stock price and the value of the underlying real estate. With a private fund like the IncomePlus Fund, you're investing in the underlying real estate, not the market's mood. When we do a mark to market and that $11.14 net asset value, that means that the value of the assets in the underlying market, if we were to sell them today, that is what they'd be worth, right? Where you have a public stock, if the stock is trading $65, the assets might be worth $80. They could be worth $40. You don't know at any one moment in time how that stock correlates to the value of the underlying assets. And over time, that distinction, it matters enormously. But I would say it's not an or, it's an and. So here's the last slide I'm going to talk about before I hand it over to Dave. And I think this also paints a picture for why this fund. We've had 5 consecutive years of dividend growth through COVID recovery, through rate hikes, through the most aggressive tightening cycle in 40 years, through a 3.5-year multifamily recession. We've seen a lot of our competitors cut their dividend, their distribution yield by 10, 20, even 50% in some cases. And we've been able to grow it every single year. And that's not easy to do. It takes discipline. It takes the right assets, the right structure, and a manager who is really focused on a balanced approach of growing both capital and income. And so for those of you who are income investors or might be someday, this really matters. And like I said, if you're not an income investor today, chances are you might be someday, but it's always better to buy a fund that can produce income. You can just reinvest that as well. So I want to take this sort of full circle back to where I started and really like what we're seeing, and even talking to team members and the conversations that, because we're sharing notes, hey, have things changed? And the mood, it really has changed. And oftentimes sentiment is the leading indicator to a full-blown recovery, right? Well, why would sentiment lead a full-blown recovery? Because one of the reasons a recovery happens is when capital finds its way back into the market. So whether you're talking about individual investors, RAAs, institutional investors, everybody's mood is above 50, 60, 70, 80, maybe even 90% in some cases. So we see an environment where capital is about to come back into the market. And I think we're really well positioned today, but we want to be better positioned. We want to continue to position this fund for the recovery that we see right on the horizon. So thank you very much. Dave, I'm going to hand this over to you right now. So take it away.
Thanks very much, Michael. We're at year 19 being partners. Let's do it another 11, round it up to a 30. That sounds right. I'll be 66 and you'll be 66. We're the exact same age, which is kind of interesting.
Well, depends what month. I could be 67.
Yeah. You got me by a couple months, but same vintage year, 1970. Thank you for joining us. We have 654 registrants. I don't know how many are live, but obviously we'll send you the deck. We'll send you the recording. And importantly, when we get to the Q&A, if you have questions, our emails will be there. Pretty unique in our industry. We want to communicate with you directly. We think that it helps inform us to be better managers and serve you better. So why now? An improving landscape. Michael was touching on this, and I'm going to start. Just my section is going to be a little bit about the fundamentals and why we're starting to move this fund towards common equity. You move towards common equity when you believe that there's an asymmetric upside, because of course common equity can go up forever in value. Debt instruments are capped, so you'll get a more protected 12, 13, 14, 15%, but that's it. This fund, if you look at the ARC, if you've been in the fund for 5 years, it's true that it's averaged a compounded annual return of 9.4. But the reality is a heck of a lot of that came in 21. And we've been doing 6 and 7 and 7.5 and those types of returns. We're due for an asymmetric upside year. I'm very confident that it's coming because the fundamentals are improving. And as you see, we're better than our competitors at managing risk and increasing returns in cycles. But let's be honest, I'd rather beat our competitors by 300 or 400 basis points when our returns are 18 and theirs are 14, right? And I actually think that's coming too. So why am I bullish? I'm bullish for a couple reasons, but the first is there's a lot of things that are debatable. You can debate future demand, and in fact, I'll cover that in a second. Lots of your questions are about that. When you ask a question like, how is AI going to affect the workforce? That's really a question about future demand, right? Because employed people with good jobs can pay more rent. That's a demand question. Supply is much easier. This chart shows it, and you can use AI or Google or just Google supply, multifamily supply from 21 to 25 or 21 to 26, down 55% since 3Q 22. That's already happened. So this precipitous drop you're seeing, straight down, we've already not had enough new starts in Q3 22, 23, 24, 25, 26, which means going forward, there will be not enough supply. There won't be enough housing to meet demand. What's interesting, I'm going to change the slide, is the demand function has actually never been stronger. In other words, record amounts of people are wanting to rent. Why? Well, one of the reasons is this graph. It's just a rational actor. I mean, think about, and this should make sense. The last time that it was much more expensive to own than rent was right before the '08 housing crisis. And then housing prices went down a lot and it normalized and it went to parity. That's the middle of this graph. Renting and owning was about the same. And then in 2021, multifamily values and home values and rents all went up. But multifamily values went back down and rents went back down, but housing didn't. We've had a few questions in about, regional. Someone sent in a question about Austin and residential is correcting there. I'm not suggesting that's not true in Austin, but the reality is the national data is the national data. Home prices aren't lower. I'm in Chicago today. Home prices in Chicago are up quite a bit. And so, nationally, they remain high. And the price of rent really hasn't moved in 4 years. And so now you're looking at this record spread. It's 63% more expensive nationally to own than rent. That explains why we have record demand. Right now, that record demand is being met by record supply. That's the supply that started in 21, early 22. But the supply is going away. The demand won't unless this changes. Either residential housing prices need to correct or rents need to go up. That's what would make, without home prices going up. And this is another reason home prices are so sticky. The average mortgage that was made in 21, 22, and these are long dated mortgages, 10-year, 15-year, 30-year, is 4.2%. But mortgages today, if you get one, I would argue they're higher than this. They're 6.4, 6.5, 6.6, 6.8. So people who own homes are very unlikely to sell homes. They have an asset, the mortgage. And that's constraining supply and keeping home prices higher than they probably should be. Of course, people will move if they have a job or a change of life event, getting married, et cetera. But for the most part, the rational actor is staying put, and it's limiting supply. And that's sort of a longer term, we're 5 years in. That could easily persist for another 5 to 10 years. There's also social changes happening that really benefit renting, the rental demand side. This is just an example, but the average age of folks getting married has gone up. It's incredible how analogous the slope is. Men get married a little bit older than women, but it's just straight up older. We're also having kids older, and we're having less kids. And so all of these things, and by the way, a lot less people are getting married too. That's down precipitously over the last 20, 30 years. There's an awful lot of people who don't get married. So this isn't a value statement. It's none of those things. I'm just simply pointing out that one of the reasons you own versus renting is there's a certainty in owning. And that comes with marriage and kids. And it's an emotional thing. I've felt it myself. I've done that. But less people are getting married. Less people are having kids. And when they do get married, they're getting married later. And so we're sort of in this three-pronged social experiment, right? On the one hand, it used to be parity to rent to own. Now it's not. It's 63% more expensive to own. Very new thing. Started in 21. Secondly, we're getting married older. We're getting married less. We're having less kids. And then third, you have this giant set of the population that are sitting on an asset, a long-term mortgage. And so like all of these things are circulating. And I would argue all of these things benefit our demand function. So I could never tell you when the next recession would be. I could never tell you, I don't know that. But I do know in a constant state world, supply is going down a lot. We know that. 55% from peak. We're 4 years in. We're underhoused, anywhere from 1.2 million to 3.5 million, depending on the source. I know it's very wide, but that's the range. And then demand function is quite high. So annual household formation, I really want you to focus more on 23 into 24. You see a big jump in household formation. Obviously, household formation helps us because household formation can be both buying a for sale home or renting. It's people graduating college or high school with enough money to form a household. 2025, I had to do quite a bit of research on this because that's a really large spike. And our research team got back to me today and said, look, 2025 includes the federal census wasn't including international immigration for the last 5 years. And rather than adjust the data, they put it all into 2025. And so when you back that out, it still gets to a very robust, it's about 1.2, 1.3 million, which is a nice number, but it's not 2.6. And so I just want to be upfront about that. The other, if you have interest in this slide, we can share the research with the deck, which is quite a bit longer than I think we want to spend on this. But the big point here is the economy's healthy. We have sub 4.5% unemployment. We're growing. People's incomes are growing. The ability to pay rent has actually never been higher because rents have been relatively flat, but incomes are going up. So we measure that in a ratio. We like ratios 20 to 25%, meaning rent to income. We're there now. 3 or 4 years ago, they were more like 28, 30%. So we like folks' ability to pay rent and importantly, pay more rent because that's what we need. I'm going to transition to portfolio activity. And I actually have notes. So if it looks like I'm reading, I will be reading because I don't want to mince words here. I want to be very specific. And then we can also address further. And so you see the bullets, and I'm sure you're reading them now. You don't really need to read them. I'll take you through them. So the good one, Q1 2026, we were 82.92% occupied with a 50% renewal retention rate. That's where we're really focusing most at Origin, is trying to get that retention rate, i.e. getting someone to re-sign a new lease up to the mid 50s or even 60%. We've made a tremendous amount of progress across all portfolio assets in the last quarter. If you're in Growth Fund 4, we'll talk about that again. Lots of progress there. We're targeting 90% occupancy by Q2. I think we'll get there. Right now, IncomePlus Fund controls the refinancing. We expect it to close in 60 to 90 days. In fact, we control the asset. And the reason we control the asset is we're exercising our rights as preferred equity, and we're taking control of the asset at this point. I want to talk a little bit about the 10% discount to face. That just means Origin is carrying this asset at 10% below the investment in the asset and the accrued preferred equity component. And so all of our valuations are externally looked at and evaluated. Altus does it for us. And they've been signing off on this. But you as an investor, if you're in the fund, you should know this asset has already been priced in at a discount to full accrual. So this isn't a conversation about like we need to take a loss or anything like that. It's already in the share price that Michael mentioned. We're currently at 102% of total value of the asset. In other words, the asset, where we sit in position, we could take a 2.5% loss. What does that mean? Because I'm sure I was talking to our head of investment management about that. I think what you really want to know more than anything else is what's our return on an asset like this? And the answer is given where we are right now, we've averaged about a 10% IRR to date on this asset. 10.6 is the total. If we were to just liquidate right now and say, okay, we just want out. So you're not taking a loss. When I say a loss, you've made 10.6%. What I'm saying is we should have made more because we were collecting more of an interest rate on our pref than 10.6. However, we don't believe we're going to take 10.6. We actually think that the point forward IRR is very attractive here. We think we're going to average 13%, and this is going to become a very strong asset for the fund on a common equity basis. And so the good one, it's located in South Congress in Elmo, St. Elmo, I should say. It's a very supply constrained, walkable urban node. And in addition to, we think that the concession environment, back to what I was talking about supply, you're going to see less supply, demand's going to remain strong, and we're going to see this concessions burn off, and then the ability to raise face rents, et cetera. Another thing that we get when we assume this controlled common equity position is we can depreciate. And so once the refinancing is done, we'll be able to depreciate this asset. As a preferred equity asset, we can't depreciate. And so that's a big benefit to every investor. And Michael was talking about that before when he was mentioning, 7-8% returns here. They're going to feel much, much higher than a equivalent taxed investment. And this provides that shelter. I'm going to move on to, and by the way, if you have more questions about this, just ask us in the Q&A. Novo Hickory, and let me scroll back to change the slide. So Novo Hickory, Highlands in Antioch, Tennessee. This is a very small position. I just want to start with that. It's 1.7% of the fund. It won't impact the fund positively or negatively much. The IRR at par would be 12.6, but currently our NAV, this is a scratch, meaning no money's been made or lost. We believe the point forward returns, again, will stabilize this and get us into a much higher IRR. So we're going to spend time doing that, focused on higher occupancy, higher rents, lower expenses. Remember, we didn't run the asset before. We were a lender. Now we're going to run the asset. And Origin, this applies to all of our lending strategies, whether you're in this fund or the interval fund, the strategic credit fund. We're an operator. We actively manage. And so if we were to take over an asset, and here we are, I think you're going to see these operations improve and value created. As a lender in any position in the lending stack, you can't do these things. In fact, you assume liability and can be sued if you start to impede equity operations. So you have to be very careful about that, but we don't anymore. And you're going to see the full benefit of why you invest with a manager that can, yes, issue debt. And we don't ever intend on taking over assets, but if we do, you'll see that the operations are going to improve here as well. In this case, it's a little bit different than the last asset. The last asset we really like long term. It's an asset we would actually keep in the IncomePlus Fund. This asset is an asset that it's not that we don't like it, but it's not viewed as a long-term hold. So either we'll sell it in the nearer term or we'll sell it in the medium term because we're trying to maximize NOI before we sell it. We don't see this as a long-term hold asset. In both cases, we get to assume depreciation. I'm going to move on to my last slide, which is the Ellison, which I'm really excited about for lots of reasons, but just starting with our development partner, which we believe is best in class. That's really where you always start. Stillwater is terrific, and we're really excited to partner with them. In terms of the demand drivers, you have Taiwan Semiconductor, their Arizona campus is quite nearby. Intel, which I was shocked to read, I think yesterday, that after the run-up, Intel's market cap now exceeds Oracle's. I almost want to double check that. Maybe someone can, because it seems so incredible. But that's how much they've run up in the last year. The renter here is educated. They have high incomes. These are the types of things we look for, renters by choice. When we went to the site, Michael and I and all of the investment committee, this is truly in the middle of great highway access, great visibility, and importantly, retail, very, very close. It's walkable. Most people drive in Phoenix, but you could walk, and it's significant. And then IncomePlus is open-ended structure. If you're investing in IncomePlus, like, one of the things that's interesting about this is we measure this. When I say it's a 6.4 return on cost, what I'm saying is we believe we'll develop this deal to an unlevered 6.4% yield. The prevailing cap rate environment, which is the unlevered yield again in Phoenix, I'm stating 4.75, but the reality is, Michael and I were out there last week. We lost a deal at 4.5. And so it's 4.75 trending lower. Back to Michael's initial slides talking about how so much capital is becoming optimistic about real estate. That's starting to push up pricing and down yield. So we believe we're developing this to a 35% premium, meaning 6.4 versus 4.75. That's quite high. And that's that 3-year period where you're getting those development returns. And then from there, we also have the lease-up appreciation. When the asset still isn't fully valued until it's leased. And that's happening usually in year 3 and 4, 4.5. So another way of saying that 20% bucket, if you think about development, and we've been doing it a long time, since 2013, I believe, was our first development. We did an awful lot of development in the sort of low 20s to high 30s IRRs. And the last 3 or 4 years have been much more difficult. But I'm a big believer that that's going to revert back to the mean. And you're going to see this vintage of development is going to really increase the value of this fund over the next 3 to 4 years. And that's why Michael and I created a fund that has exposure to everything we do. So with that, I believe we're on to Q&A. And Michael, do you want to get started and I'll take the second one? All right, I'll take the first one.
I'm back.
You there? You're back. I'll take the first one anyway.
Yeah.
The first question, I just remember this because I was reviewing the questions emailed in, and I just thought it was such a good question. It's kind of the question, which is, what are your capital flows in the fund? Like, what are investors doing? What are they saying about this fund? And it's pretty important. It's a great question. So I wanted to make sure I was right. I actually called investment management right before because I didn't want to be kind of right. I wanted to be right. We've averaged between 2.5 and 3 million of redemptions per quarter over the last 6 quarters. So let's just say, let's round it up and say that's an annualized 12%, or sorry, 12 million. So 12 million is roughly 2% on an annualized basis, redemption of a $600 million fund. And obviously our capital raising far exceeds that. So I'm guessing that question was asked because some of our competitors in other spaces, some of the funds that lent to software companies or other strategies, remember, we're lending to a hard asset that you just saw it. We made a loan and it was pref, but now we're taking it over as common. And in one case, we made a 10 IRR, and the other, I think it's going to wind up just fine. There's a lot of fear in the software space because if those companies start to struggle, they kind of go to zero and there's nothing you can do. And so there's massive redemptions in these other funds, 10%, 20%, 30%. They're not being fulfilled because they're not letting people out, but that's just not the case here. We've averaged 2%. I think our investors are quite happy with the fund, and our capital raising exceeds that significantly.
I'll take the next one. Al, thanks for participating today. Appreciate the question. Good to hear from you. Al asks, with shift in the direction of the fund going forward, will the fund remain in the same markets or look at other new markets? Al, right now, we have 12 markets that we cover. That's plenty. We're always looking for new markets. We're evaluating the markets we're in. As you know, we got out of Chicago recently, just long term. We're looking at things going out 5, 10 years. And we also want to scale in market. There's an advantage when you have 2, 3, 4 properties in a single market. So it's constantly, I don't want to say that we're not. And I also, we're not actively looking. Certainly with 12, they all have different dynamics. Some are under a lot of stress right now, like a market like Austin, and some are, Phoenix, certain parts of it. You can find the northern part, like Scottsdale, doing incredibly well. You go into other parts of Phoenix and, we probably wouldn't want to invest there today. So we have our hands full with the markets we're in, but constantly evaluating. Thanks for the question.
Next question. Cap rates feel low relative to interest rates. As an investor, if you had to pick between debt and equity, which would you pick? For the last 3 or 4 years, I would have said debt. Now I'm ambivalent. I think they're both good options. And I understand you didn't use a name, but the investor or partner or potential, whoever asked the question, I get the question. But a cap rate isn't just the unlevered yield. it's the total future value embedded in an asset that's terminalized. So that's the cash flow today. It's the expectation of future cash flow, and it's a terminal value. By a lot of measures right now, real estate, multifamily real estate is actually very low priced, even though I agree with you, the cap rate, interest rate is interesting dynamic. But, from a replacement cost standpoint, you could come to a very different conclusion. And candidly, a lot of people are. They're saying, well, wait a minute, I can buy great multifamily real estate at similar pricing to 2022, but the stock market's up 100%. I'm in. And everyone has a different lens. And so you're using one lens. I hear you, but there's others.
Ben asked the question, and others asked the same question, so maybe I wasn't clear. He said, who is paying for the 1% bonus being offered? Ben, we are. So sorry if I wasn't clear about that earlier, but this does not come out of the fund. This does not come out of the investor's pocket in some way. This comes out of Origin Investments, the company. Actually, we will write a check for those bonus shares, and that comes right out of our bottom line. Dave, let me grab one more question. John asks, is Zola still on track to be added to this fund in early 2027? That's question 42 on my screen. John, yes. In fact, we mentioned earlier that we're down in Phoenix last week, and you're going to be pleasantly surprised with that deal. I mean, Phoenix itself, everything that's going on around there. We toured the Zola property with the entire team, so there's probably other investors on this call who are part of Zola. It's looking great, and there's a lot of things happening around that neighborhood as well.
So, Michael, I'm going to take one more question. I have to catch a flight, but you know that you're going to take us home. I know you can answer all the questions. By the way, my email's there. Please email me if you have questions. Daryl asked a question, and then I'm going to sign off for me. You've been bullish on ground up multifamily development since last year. Have conditions gotten better, worse, or about the same? Daryl, they've improved, actually. I'm more confident than I was a year ago in ground up development. The demand is strong. Supply continues to burn off. There isn't new supply coming. I think you're going to really have tailwinds at that point. And then we're going to publish an article on this. I have to review it on the plane, but our construction management teams and investment management have just written an article about tariffs and the run-up in oil and how it affects construction pricing. And the cliff notes is construction pricing is lower, and that will seem very counterintuitive, but it's true. Even though the inputs are up, general contractors and subcontractors are really seeing that they don't have future work. And so, back to there's no supply, there's no backlog for them. And so they're getting extraordinarily aggressive with pricing and cutting margins. We're seeing at final bidding 3 to 5% savings routinely, and year over year, a negative inflation rate in construction. And so it's a really good time to start. So our select asset fund benefits from that. Obviously, IncomePlus benefits from that. I think this is going to be a really good vintage. That's my opinion. Michael, thank you very much for covering for me. I will call you later, and I'm going to sign off. Thanks, everybody.
Of course. Safe travels, Dave. All right, I'm going to stay on for a while longer. I'll cover a lot of these questions, and if I don't get to your questions, you can always email me, Michael at origininvestments.com, or you can email David at origininvestments.com. It's just about time. We don't want to be too far over, but I'll go a few minutes over as well. David asks, regarding Goodwin, how did the performance vary from pro forma to the point you decided to take control of the asset? Any lessons learned from that experience? Yeah, David, a lot of lessons learned from that experience. I mean, both positive and negative. I think we did some things right. And when you get the city right and you get the asset location right, and in many ways the sponsor right too, there were things that were really outside of their control. They put a lot of equity into that deal. They tried as much as they possibly could. They're still in it. They've got a hope note, per se, if you will. But at the time when we were investing in that deal, and I can't remember exactly what vintage that was 21, 22. senior lenders debt. I mean, banks were going up to 70%. It was forcing us into that sort of 70 to 85% area. And it was, in a ground up development. And there were, everything that could go wrong in that deal did. And ultimately, the sponsors got wiped out. But we're a little bit different than a bank. If a developer hands the keys back to a bank and they don't want it, right? They don't know what to do with it and stuff. And I don't want to, there might be bankers on this line, but generally a bank does not want assets back. We don't mind, right? And so we always think about these things when we're lending through the eyes of the owner. Where's our basis, things like that. I don't think any of us realized or could think of when we look back 4 years ago how far Austin could have slid. But I many people, probably including yourself, were around in 08 and 09, and we were investing in Austin at that time, and every single crane went down, and assets were trading 40, 50 cents on the dollar. 5 years later, assets were trading back at replacement cost. Cranes were back in the air. So Austin is going to be back as a city, and I feel really, really good about where our cost basis is right now. Are there things that I'd like to change and things we've talked about internally? Absolutely. And it certainly didn't, our pro forma always assumes that, the lender, the borrower pays us off. So it didn't go according to pro forma. And David even said, we've generated about a 10.6% when we convert this thing. And I think that deal was priced at around a 13. So it's not, a horrible story. And I love the fact that we can just convert this into common equity. Al asked, how often are the properties priced by Altus to determine? So Altus does all of our valuation. We've outsourced that. We used to have a hybrid between internal and external, and Al, that is done on a quarterly basis on all our deals. Jordan asked the question at the beginning of the presentation. You mentioned, and I think this was me who mentioned this, that you believe we are entering a generational buying opportunity, yet you're targeting a full allocation to development at 20%. Would a generational buying opportunity result in acquisition opportunities pricing below replacement cost for new development? If that's the case, wouldn't some of those dollars be better allocated towards new acquisitions rather than development? And Jordan, yes, I think when I say buying opportunity, I use that term as it's a great investment opportunity to put dollars to work. Certainly for investors coming into this fund, they're buying real estate at today's market prices because that's how they're priced in the fund. And you also have to think about right now, our ground up development sleeve is 11%. And so we only need another 9% to top that off. So when you think about that, that's 54 million. It's like a deal and a half, right? We cover 12 markets. There are always opportunities out there. I will be the first to admit, though, that, I've talked to people about this. If you want to know where we're being, overcompensated, fairly compensated, undercompensated, I think development in many ways, it depends on the market, on the submarket, but that is not a scalable opportunity right now because you're being undercompensated certainly in certain markets where the entire market, I used Austin as an example, I use that again, not to pick on it, where you wouldn't do development there today. It's all trading below replacement cost. But are there pockets of Phoenix or are there pockets, within the state of Florida or in the state of North Carolina or Texas? Absolutely. So, I would like to, our job is to invest in the best risk-adjusted opportunities we can. We put guardrails around our development, so it's only at 20%. But what we'll also be doing with this capital, this was a mention about Azola, we have a lot of sidecar capital that's sitting out there waiting for us to acquire back. So we have an entire pipeline of sidecar capital that we can buy back tomorrow. So the beautiful thing is, no matter if this program is incredibly successful and we brought in $100 million, we could put it all to work in the next 2 to 3 months. Thank you for your question. Dan, nice to hear from you, Dan. What about an aging population that will eventually lead to many more home sales and reduced prices? So, Dan, I'll be the first to admit my expertise is not in home prices. I know that there is a huge shortage out there. These are the ripple effects going all the way back to 08. And they're also because we had this world of incredibly low interest rates. And you have so many people who are locked in at 4, 3.5, even 3. Nobody's letting go of their houses. My sister-in-law, she just tried to buy a home in the suburbs. They had 18 offers on the second day of showings. It's absolutely insane what's going on. I think the market would actually breathe a sigh of relief if more and more people started selling their homes. But the single family home market, I think, is where the largest segment is of the housing shortage. I actually don't think there's a housing shortage in multifamilies, but people in the multifamily segment, because there's been a lot of building over the last few years, and you can see what's happening to rent. But the choice between renting and buying now, it's not really a choice for some people because owning is so expensive. And in some ways, they can't even own because they can't buy a home out there. So thank you for the question. Appreciate it and love to see you attending the webinars. Manan, you asked this question for Dave. I'm going to answer it. Do you see much in the way of macro risk to your outlook? Interest rates, recession due to oil prices, or anything else? Yes, the absolute answer is there's always something that can, derail the party. There's always something, there's an X factor out there. The question really, when you're entering into a new market, is you're evaluating the risk, the reward, the upside, the downside, where you are in the cycle. And there's certainly better times to start investing than others. And that's what we're saying is right now, it feels like based on where we are, with cap rates, with interest rates, it's what's going on in sort of even the global economy, with what's going on idiosyncratically within the supply picture of multifamily itself, it feels like a really good place to enter. And we're optimistic about what's going to happen. There was another question here about, interest rates, cap rates, rental rates. And I think about it, like this. You can actually have a world in which interest rates rise and cap rates rise, but you also have rising rents as well. And that's a very likely scenario in the next couple of years, because no differently than a stock, if you have a company that earns $1,000 and its multiple is a 10, that value is $10,000. Well, if those earnings go up to 2,000, and that company is still at a 10 multiple, now it's worth 20,000. But if the multiple goes up to 20, now you're at $10,000. You're right back to where you were. So we in real estate, it's no different. The multiple is really the inverse of the cap rate, and the earnings really shows up in the rental rates as well. So I see a world as even if cap rates and interest rates stay where they are, the market is going to recover significantly over the next year or two. If we get a tailwind, that is absolutely phenomenal. If we get a headwind slightly with higher rates, higher cap rates, it doesn't ruin the party either. I think, we'll just make a lower rate of return, but probably something closer to the historical average in this asset class. Gary, I got your question. I think I already answered that. Michael asked the question, great question. If there weren't capital inflows, would the fund be able to support its dividend from operations? The answer to that is yes, Michael. There are a lot of different cash flow streams within the fund. We have the preferred equity, we have current pay, we have preferred equity that's constantly paying off. We do have we have income from operations as well. And you also have to keep in mind that a little more than 60% of the people actually opt in for the distribution reinvestment. So our obligation to pay the distribution yield is only about 40% of the people. And in some of the ways, I should say more than some of the ways, that dictates the way that we set up the fund and how we are managing and structuring the different investments. If everybody wanted income today, we would be investing differently. We would be investing in probably lower return, higher income securities, things of that on the debt side. To provide that, we would be investing more in core stabilized assets and wouldn't be doing much on the development side. So it would really change the makeup of the fund as well. But great question. Happy to follow up with you on that as well. Kai asked, do you see any crowding out from AI data centers in terms of capital and construction resources? Kai, not today. The multifamily developer, the data center developer, they're very different. I would think, though, that they do somewhat, kind of come from, take from the same pool. And I was just listening to a podcast recently. I listened to the All In a lot, and they were talking about, I think it's the top 5 companies this year alone, they're putting in $750 billion into CapEx. So CapEx is going, north of $1 trillion. We talk more and more about how AI might be this disruptive force. from my seat, and all I can see today is that it has done nothing but create jobs. And even at origin, the new jobs that we're hiring, they didn't even exist 3, 4, 5 years ago. So there will be a changing landscape out there. It's sort of wait and see what's happening. We're not feeling, the pinch right now, but, labor is scarce and there's a finite amount of it. So I'd imagine over time we might be feeling some of that. It's 3:00. I'm going to keep going. So hopefully, I'll get to a lot of your questions here. Matt, great question. He said, all great and exciting news. What could disrupt this momentum? I kind of answered this before. There's always the X factor out there, interest rates, the things that we can't think of, but nothing within our control or that we can see today. But I think that, that's the same thing that holds true for every investment in your portfolio out there. So I'm not really sure. I mentioned AI. There's two different camps there. Some people think that it's going to be the greatest growth engine of our time, and we're going to see the next industrial revolution. And some people believe that it's going to, set, the economy on a course or unemployment of, 10, 15, even 20%. So I'm more on the former part of that. I really think this is an incredible time for the entrepreneur. And I've never had so much fun with a new tool, and we're integrating it here at Origin. We have enterprise AI that we're building into all of our systems, connecting our data. And I just think it's steroids for the entrepreneur to be able to build businesses. And for these large bloated companies that we hear about all of the layoffs, it's kind of like a GLP-1 for them. And I see it. I mean, when you've got, 400,000 employees spread across the globe, there's probably a lot of fat to cut in those companies. But for entrepreneurs today, if you have an idea, you can pretty much create a company in a weekend, which is to me, exciting times. Gary, great question. You compared your fund to the public REITs. How is the return of just your equity positions versus the public REITs? Gary, I'm not sure that is the, I know what you're asking when you're looking at the public multifamily REITs. I think the best index that we can compare ourselves to is the NAREIT index, which includes both mortgage REITs, right, which you have debt REITs in there, and then you also have the all equity REITs, and that is on that chart. When we look at the all equity REITs by themselves and don't put that debt inside them, we also outperform those on a 5-year period. And part of the research I do in this is asking the AI to find indexes and benchmarks, that we have not outperformed over periods of time. And it's hard. It's really hard. This fund is done incredibly well. And you can look at any public ETF that focuses on REITs. And I challenge you to find one that has beaten this fund over the last 5 years. That's either like a diversified public REIT or something, specifically on the multifamily side. Certainly, there's sectors out there, data centers and things like that are more positioned for the technology center that have done incredible. Let me keep going down. So I want to get to, everybody's question if I can. That's not really realistic. I would be here till probably another hour, but I've got about another 7 minutes. John, I'm going to get to your question. Hi, Michael. All good news today. Quick question on the IPF bonus. In addition to the 1% additional shares, I was told that Origin will also waive the admin charge. John, you are absolutely correct. I should have mentioned that. And yes, we are waiving. We're taking a holiday basically on the admin fees. So that is being extended to you and anybody else who comes in. Can't believe that, one of my punchlines I forgot. So Ty asked, does Origin plan to launch QOZ funds for the new QOZ? Ty, that's a little bit outside of this. The quick answer is not really. Not a fund. We have to wait to see what the new maps are. I'm not as optimistic about the new maps that are going in for QOZ 2.0. We will always be looking for deals. So, if you have a QOZ need, just let us know and we'll always, we'll log that. We're looking, our team's constantly looking, but I imagine they're going to be one-off deals that we bring to market because it's incredibly difficult to scale a fund in a market where all the maps have been redrawn. Dan, follow-up question from you. Thank you. What about the real possibility of huge I just answered this. So hopefully you got your question answered. But Dan, feel free to give me a call or shoot me an email if you want to, continue that discussion. There's, like I said, there's two different camps. We're looking at the data. AI is something I absolutely love. I'm getting excited about. And the reality is nobody knows today, and it could be a net creator of 90 million jobs. And I think Anthropic has been sounding the alarms, which is kind of interesting, but they're the ones who have been the doomsayers in that particular sector. I'm not sure how it benefits them, but apparently it is getting more and more people to adopt it, or at least take shape. So let me keep going here. Vixen, I'll answer your question. Regarding the Hickory project, was this an investment where the multi-lytics projections didn't materialize as expected, or is the decision not to invest more a reflection of a broader shift away from that specific submarket in favor of higher conviction areas like Nashville's urban core? Vixen, it's not that multi-lytics got it wrong. This is also kind of one of those moment in times. This was a little bit, this is southeast of Nashville, if I recall correctly, and this is the Novo Hickory project. It's a casualty of what happened. I think this project is going to do very well. It's going to draft off kind of the halo effect of the broader Nashville area. I'd have to come back to your question because I don't exactly know what the multi-lytics projections look like. But if anybody has seen our letter, we recently sent out something about multi-lytics, about what we got right, what we got wrong, and what we're doing, because forecasting the future is impossible, right? There's nobody who can tell you that they can do it with absolute accuracy. And multi-lytics, I would call the best product out there, but there are always going to be variables that even multi-lytics doesn't pick up, but it's better than not having it. And I think in multi-lytics, it wasn't about getting the call wrong. It's about the timing a little bit. And the last few years have been, worse than anybody ever thought could be, with the confluence of interest rates and cap rates and supply and hurricanes coming through, forcing insurance up, and expenses and inflation and everything else that, could go wrong. So a lot of stuff there. Happy to talk to you more about it. You can email me and I'll follow up. Manan asks a great question, and hopefully I'm saying your name right. I apologize if I'm not. Are there co-investment opportunities with IncomePlus deals? Yes, there are. We do not have any today, but I will guarantee you, if we find some development deals, like I said, that sleeve is about $50-55 million in size today, that we have the opportunity to fill that up with new development deals. As we find those, we will likely put half of the deal into the fund, and then the other half we will bring out to IncomePlus Fund investors to do a sidecar in that deal. And it's more just for sizing purposes, because we can go out, we don't want to go find a mega deal to fill up that whole sleeve. Joe asked, can you elaborate more on Azola, especially versus your underwriting expectations, and how Azola would enter this fund? So Joe, I'm not sure if you're in Azola or not. Azola was a deal we did, I think it goes back about 18 months, could be 2 years now, based on where it is in the construction process. But Azola is in Phoenix. It was an amazing story, and the story really sold itself. And I give a lot of credit to the team for uncovering this deal and putting it all together. And it was definitely one of these outliers that we find in the market. So the IncomePlus Fund took a piece of that. We also laid off a piece of that to all of our investors in a sidecar. And ultimately, the way sidecars work is that at the end of, call it 24 months, which apparently is in 2027, somebody asked before, we will go out then and give people the opportunity to convert into the IncomePlus Fund through a 721 exchange. It's a tax-deferred exchange. And the goal is also to buy the remaining interest, the people who don't want to come in to the IncomePlus Fund, in cash. So ultimately, that deal will be in the fund at the time when construction is done. That is the plan today. Hopefully that answers your question. Chambers asks, how do the tax advantages from equity investments accrue to investors, further enhance the risk-adjusted returns? Chambers, everyone gets the advantage of depreciation. So when you think about owning real estate, there's several tax advantages. Number one is depreciation that flows up to the fund. And then the magical thing about this fund, and what I get excited about, is that when we were concepting this fund, If you have a debt fund and you have an equity fund together, there's oftentimes in the equity fund, there's excess depreciation that does flow to the investor, right? But that's through an LLC or a partnership, right? And that shows up on a K1. In this case, it's done through a REIT. So everything gets caught up before the REIT. So the preferred equity actually creates taxable income. But what happens then, the excess depreciation cancels out that taxable income. So what the investor sees at the end of the day is a yield that really is incredibly tax efficient. Maybe it's, there's no taxes this year. Maybe there's only 10 or 20% on taxes. We can't, guarantee that at any one year, but that's one of the main things. And then within the fund structure, when we refinance an asset, that's tax-free. If we sell an asset, we do a 1031, that's tax-free. And so all of that inures to the benefit of investor, because we're very tax-minded in this fund, because after all, what matters is what you take home after taxes, not before taxes. And I would tell anybody on this webinar that you always want to evaluate things on an after-tax basis. And being in real estate, one of the reasons is it is one of the most tax-efficient investments that you can get into. Todd, thank you for the compliment. Really appreciate that. Todd was just talking about a deal that we ended up selling in Hyde Park in Tampa. So that was an absolutely great deal. Yeah, loved it. Loved the entire experience. So we're going to do more of those. Let's see here. Let me keep going through this, and I appreciate everybody. Everybody's staying on through the end here. It looks like the questions are slowing down. So this is the last one I'm going to take. Ty asks, which part of the capital stack do you like the most for the next 5 years? Ty, I think we vote with our actions more than anything. And, you can see in what our actions are, we're reshaping this entire fund. So we're reducing debt. I think debt is a great place today. And I've told people, like, our debt fund and the credit fund and the interval fund on that side, we're still being overcompensated for risk. But if I'm looking out into the future over the next 5 years, I want to be positioned in the common equity because of some of the things that I see happening in the multifamily market. And I think you're still getting paid a really good return if you're early, or if you're wrong. I think the downside is extremely limited on the common equity side. But don't forget, we're also, like I've talked, we're never going to be to zero in our debt side. We're always going to be 20, 25, 30% on that side, even at its low point. So we'll always have downside protection through those, through that part of the fund. It just will be heavily tilted toward the common equity and the ground up development side. So, okay, with that, I said it was my last question. I appreciate, I know I've been talking fast. We've been on for an hour 12. I wanted to get through as many as I can since, Dave had to jump on a flight. Thank you so much for listening in today, staying the entire time. We appreciate your partnership. If you are an existing partner, if you're a new investor and you want to continue, to talk about investing in the IncomePlus Fund, we welcome that conversation. So email us. We'll have the conversation with you. We'll set you up with somebody on our investor relations team. And if you're not ready for a conversation, just go to our website. We have a ton of information there about the fund. You can download the deck. You can get all of your questions answered about the fund fees, some of the particulars, things like that. And so that's a great place to start as well. Thank you very much. I appreciate your time, and have a great rest of the day. Bye-bye.